All right, let's just jump right into it. We live in a world that, let's be honest, moves faster every single year. We make decisions in milliseconds, and news travels the globe before most of us have even poured our morning coffee. But in this lightning-fast world, there's this massive, almost unbelievable paradox. The single most powerful advantage in finance today is something almost nobody wants to talk about. It's actually the reason 99% of Warren Buffett's wealth came after he turned 50. So why do people avoid it? Well, because it is incredibly, painfully slow. Welcome to this explainer, where we're going to break down the paradox of patience and uncover the absolute ultimate advantage of history's greatest investor.
So think about Warren Buffett for a second. He has built one of the most extraordinary fortunes in human history, right? And it begs a really simple question. What exactly separates him from everyone else? What separates him from all the other incredibly smart, hardworking, well-connected investors who tried their hardest and totally failed to match his results? Seriously, take a second and think about what you believe the real secret to his extreme wealth actually is.
I know what you're probably thinking. Most people assume that extreme wealth requires extreme complexity. But the single quality that separates Buffett, it's not his intelligence. I mean, yeah, he's undeniably brilliant, but that's not the secret sauce. It's not exclusive access to inside information either. And it's definitely not the size of his team or some ultra-sophisticated algorithmic model.
The actual secret is something way simpler, a lot quieter, and honestly far more available to everyday people like you and me. It is radical patience. And I'm not talking about the kind of patience where you wait a few weeks for a stock to bounce back, or even holding an investment for a couple of years. We are talking about measuring time in decades. It's this profound, almost uncanny ability to sit completely still while the rest of the financial world is just spinning in frantic circles around you. It's a superpower, and it's one that is almost entirely ignored.
Now, there is a huge misconception here that we need to clear up. A lot of people picture patience in investing as just, sitting on your hands doing absolutely nothing, just passive waiting. But think of a farmer in early spring. He preps the soil, maps out his field, plants the seeds, and then he waits. To anyone watching, it looks like he's doing nothing. But beneath the surface, that wait is enormously productive. Roots are spreading, seeds are germinating, the biological growth is happening exactly on schedule. The farmer doesn't go out and dig up the seeds every hour to check on them, right? Patient investing is exactly like that. The hard work is in the preparation and the selection. Once the seed is planted, doing nothing is literally the most productive thing you can do because the math of compound interest is quietly building value for you in the background.
But here's the catch, and it's a big one. The real challenge is biological. Our human brains are simply not built for patient investing. Thousands of years of evolution hardwired us for fast reactions. Loss aversion is what kept us alive in the wild when a predator was chasing us. But in finance, those exact same ancient survival instincts are totally toxic. That impulse you get to sell when prices fall or to buy when a stock is surging because everyone else is doing it, those quick reactions feel like you're taking control. They feel responsible. But in reality, they almost always destroy wealth.
Buffett actually hit the nail on the head with this dynamic in one of his most famous quotes. He said, "The stock market is a device for transferring money from the impatient to the patient." Notice how specific his phrasing is there. He doesn't say money moves from the uninformed to the informed or from the unintelligent to the intelligent. Nope, it moves based on patience. Over the long run, simply being still generates returns that frantic, everyday trading just cannot touch.
Let's look at how this plays out in the real world, with a concrete example. Back in 1988, Buffett started quietly buying up shares of Coca-Cola. Now, this wasn't some top-secret tech startup. Literally everyone knew Coca-Cola. But Buffett saw a durable, lasting brand that he was willing to wait on indefinitely. Fast forward to the financial crisis of 2008. Markets all over the world dropped by half. Coke stock fell right along with them. A normal, impatient investor would have panicked, felt sick looking at their shrinking account balance, and sold. But Buffett, he just held. Why? Because people were still out there drinking billions of servings of Coke every single day, and the company kept paying its dividend. By just holding through the global panic and reinvesting, he unlocked massive compounding over the decades.
To really lock this idea in, let's try a quick thought experiment together. Imagine you own a really nice 12-unit apartment building. It's in a fantastic neighborhood, and all 12 of your tenants pay their rent flawlessly on the first of every month. It's throwing off solid, predictable income. Then, one Tuesday morning, the local paper runs a huge headline saying property prices in your area might fall because of economic uncertainty. Are you going to panic and immediately sell your building that afternoon? Of course not. That newspaper headline didn't change the fact that you collected rent or change the physical condition of your building one bit.
And that thought experiment perfectly highlights the critical difference between price and value. Patient investors deeply understand that a falling stock price does not mean the underlying business is actually deteriorating. The daily mood swings of the stock market are not a reliable measure of a company's true intrinsic value. Once you truly internalize that difference, you stop treating every little market hiccup as meaningful information, and you start seeing it for exactly what it is, just noise.
Now, here's where it gets really interesting. Patience isn't just about holding on to what you own, it's also about extreme selectivity before you even buy anything, which brings us to a very specific and frankly, very important number, 20. Buffett uses this brilliant analogy that I just love. Imagine you're given a punch card, and it only has 20 slots on it. Every single investment decision you make for your entire life costs you one punch. When those 20 punches are gone, that's it. You can never make another investment again. Think about how radically differently you would act. You definitely wouldn't waste a punch on something that was just okay or on some hot tip your neighbor gave you at a barbecue. You would wait for however long it took for an opportunity that you were absolutely certain about. You see, you don't need hundreds of clever trades to get rich. You just need a very small number of excellent decisions followed by intense, relentless waiting.
Over a 30-year timeline, this philosophy creates an absolutely massive wealth gap. Picture two investors who both start out doing great research. Investor A buys, waits, totally ignores the news, and just steadily adds funds. Investor B is active. They're reacting to every earnings report, trimming their positions when they get scared, chasing exciting new trends. After 3 decades, Investor A almost always crushes Investor B. Why? Because the active investor paid a huge price in friction, trading fees, slip-ups, and honestly, a ton of psychological anxiety.
Oh, and we cannot forget the biggest hidden killer for Investor B, tax drag. Every single time you sell a winning investment, you trigger capital gains taxes. That tax payment instantly and permanently yanks a chunk of your capital right out of the compounding process. The patient investor, who just holds for decades, defers that tax cost entirely. The money that would have been mailed off to the government stays right there in the account, compounding and growing year after year. Over 30 years, that uninterrupted math creates an advantage that is just staggering. So if it's this simple, why is it so incredibly hard to actually execute? Well, just look at the environment we live in. The financial media trap is literally designed to break your patience. News networks, financial websites, those shiny investment apps, they are all built on short-term thinking. Think about it. A headline that says, your company is having a nice, quiet, uneventful decade isn't going to get any clicks. Fear, panic, and the latest hyped-up meme stock, that gets clicks. They manufacture daily urgency and provoke your emotions because that is exactly how they make their money. It is absolute poison if you're trying to be a patient investor.
So how does Buffett bypass that trap? He basically puts himself on a strict information diet. He completely isolates himself from the noise so he can focus on the signal. He isn't sitting there obsessing over a glowing red and green ticker all day. Instead, he reads long-form annual reports, deep business histories, biographies of great builders, and multi-decade industry analyses. He only consumes information that's designed to deepen his understanding of a business over the long haul. He completely tunes out the daily frenzy that tempts the rest of us to act impulsively.
And tuning out that noise is absolutely critical if you want to capture that steady, invisible accumulation of wealth. Take McDonald's back in 1972, for example. It wasn't some hidden gem nobody knew about. It was a highly visible, growing business at a perfectly reasonable price. If you bought shares back then and just held them through every recession, every market crash, and whatever public panic happened when they temporarily discontinued the McRib, your position would be worth hundreds of times your original investment today. The real quiet tragedy of investing is that the opportunities are right there. The logic is totally clear, but the emotional discipline to do absolutely nothing for half a century, that is incredibly rare.
But here's the thing. That kind of emotional discipline only comes from deep understanding. Look at Buffett's massive bet on Apple in 2016. Wall Street analysts were totally shocked because he famously avoided tech stocks. But Buffett didn't see a volatile tech company at all. He saw an unstoppable consumer brand with a massive, impenetrable economic moat. He realized the iPhone was woven into the fabric of daily life, and the switching costs for a user to leave that ecosystem were huge. So he bought at a fair price and just held right through all the extreme tech volatility. His conviction didn't come from staring at a stock chart, it came from deeply understanding customer loyalty.
Now, there is a second dimension of patience that we have to talk about, and it's the patience to hold cash. There are long stretches where Buffett literally sits on billions of dollars in dry powder for years at a time.
Not because he's lazy or out of ideas, but because he flat out refuses to overpay. Honestly, most people just cannot tolerate the psychological itch of having cash sitting on the sidelines while a bull market is roaring upward. But overpaying for a business permanently handicaps your future returns. You're starting the race 10 yards behind the starting line. Waiting patiently for genuine intrinsic value is just as critical as holding it once you finally find it.
Okay, so how do we actually build this into our own lives? Well, here is a practical 3-step action plan. First, you need to understand exactly why you own a specific business or index fund. True knowledge is the foundation of being able to sit still. Second, automate your strategy. Use dollar-cost averaging to set up regular, totally emotion-free investments. If you set a fixed amount to invest automatically every month, you don't even have to make a choice based on how the market feels that week. And third, when the market inevitably panics, and it will, do absolutely nothing.
I want to wrap up this explainer with what is probably my favorite thought from Warren Buffett. He once said, "My favorite holding period is forever." Think about that. In a modern world that constantly demands speed, optimization, and instant gratification, the most profitable and profound action you can possibly take is the absolute hardest one, trusting the process and holding still. So I'll leave you with this question to chew on. The next time your screen flashes red, the headlines are screaming, and every human instinct you have tells you to react, will you have the strength to do absolutely nothing at all?